Hello fellow traders, and welcome back to the T3 Trading Edge short course. In today's video, I will review the trade opportunities I identified over the 8-day trading period starting on Fed Day, March 16th, and ending on Friday, March 25th. As I was accumulating slides each day for my last video, I realized that I have never seen a video that highlights the trades each day over a consecutive number of days. Markets have an ongoing narrative. Great trades can be stocked days in advance, and it is common to reuse some of the key references, not to mention that we better be using the same trading plan day after day. In my opinion, something significant is lost when we just look at each day in isolation. Looking at a series of days also lets us better see institutional campaigns of buying to sell and selling to buy on the higher time frames. In turn, this introduces an important fourth option to the typical mindset that each trading day has to conform to one of three options: an up, down, or sideways day. As a consequence of not studying series of trading days, I think trader education is missing a chapter on how traders can effectively use the higher time frame charts, like the daily, weekly, and monthly chart. I have heard some scalpers remark, "Who cares about the daily chart? It is irrelevant to scalping." This video should serve as an appropriate response to that type of comment. For the purposes of this video, my focus will be on the daily chart. You can apply the same approach to the weekly and monthly charts. For a little background, each day our mission as traders is to identify the best areas where we anticipate we will be offered profitable trading opportunities. Great opportunities offer high reward at comparatively low risk, repeating behavior, and some acceptable frequency of occurrence. For you, that might be, for example, some double top or bottom pattern that occurs about 3 times each session and offers a 5-to-1 trade outcome. That's great, but it's not complete. Great trade opportunities only present for seconds, after which you would need to start chasing the trade. As humans, we are not equipped to do a ton of mental gymnastics so fast like the algos can. To capture these opportunities, we need to be prepared in advance. This requires simple setups that are visually obvious and identifiable well in advance so that we can be stalking them. Each of the 3 trading edges that make up the T3 Trading Edge helps you with this process for trade opportunity identification and stalking. Your task, therefore, as you watch this video is to keep asking yourself, are the trade opportunities simple and visually obvious in advance? Okay, with that said, let's begin. I start with the daily chart for ES. So where are all these obvious trade opportunities between March 16th and the 25th that I alluded to? Some are obvious and jump right off the chart. Others are less obvious. The 2 purple lines mark a swing high and a swing low formed last fall and that have been repeatedly important since. I expect price will get back to one or both of these levels and test them again, offering us trade opportunities. But price is not back there yet, so let's remove them for now. Here I've added 8 price references in addition to the 4 moving averages, giving us a dozen to work with. The list is not exhaustive, but was certainly sufficient for trading during this period. Each of the 8 horizontal references corresponds to a previous daily high or low, but most are more than that, and some are not what you might consider the most obvious choices. 6 of the references define 3 imbalances, which include a fresh imbalance, a wick imbalance, and the retest of a partially filled imbalance. An imbalance is a zone of one-sided price action on that time frame, which you will spot as the zone of a middle bar lacking any overlap of price with the bars on either side of it. 44.92 corresponds to the major and very obvious swing low from last December. Yes, it has been traded through many times in the month since. I show it because institutions and investors still consider it important, and hence so do I. Lastly, we have 43.37, which if you recall from my last video, I used this level to identify a stop hunt of several previous highs on the intermediate time frame. Starting with March 16th, price opened with this obvious gap up in an overall daily downtrend, which is pretty amateur price action, so traders should have been looking for this gap to fill in due course. The high and close of March 15th should therefore have been on your radar. From the last video, here's the 15-minute chart showing that I was looking for the intermediate timeframe uptrend to reverse down after the stop hunt at the higher timeframe reference for a swing down. Here's the 1-minute chart showing the entry short after the lower timeframe uptrend was broken. On the way down, price did pause at the previous week high, previous week open confluence, then at the 20-day EMA, then the previous day high, before filling the gap on close and reversing strongly upward, again pausing at the 20-day EMA and the previous week high, previous week open confluence. Seeing price react to key references helps me to better anticipate and understand the overall market context, plus when where I should enter or exit. If I see price react to a key reference on one time frame, then I anticipate it will react to other key references on the same time frame, as well as those on the next higher time frames. Entering the V-bottom gap fill at the low of the day is not an easy entry for most traders because it looks like one has to catch a falling knife. However, seeing how precisely the bottoming candles formed at the previous day's close was a decision-making game changer for me at least. It is a game changer because price is not reversing in mid-air, but with specific purpose at a very specific price reference. As an aside, traders often have strong feelings about which is best, the 4 p.m., 4:15 p.m., or the new close of 5 p.m., all in Eastern Time. The price reversal cast its vote by occurring at the 4:15 p.m. close. So don't just blindly use the default session templates, because that translates to trading blind, as you can see here. Price closed this day at the high of the day, suggesting the market auction was incomplete and higher prices in the overnight should be expected. Overnight price made a higher high, completing the auction, so it was then reasonable in an intermediate time frame uptrend to now look for a retracement back to support. The overnight did a complex two-legged pullback holding 43.37 on the first leg down, then dropping down to the previous week high before resuming the uptrend. Note how 43.37, which had just been support, flipped to resistance, which is our clue that institutions are still using it. So for us to use 43.37 again for a long entry, we have two choices: seeing a short below it fail, or a long pullback from above it to hold. And we got both on the 14th. If you weren't able to get long around 43.37, price paused to test the current month open and previous month close, giving us two more opportunities to enter long. Price ended the 17th up above the 43.90 quarter reference from the daily chart. Overnight then sold off from the high of the 17th to range between 43.90 quarter at the high and the previous month close. Again, we have the expected retracement in an uptrend, and it is reasonable for us to conclude it is the institutions, not retail traders, continuing to respect the daily, weekly, and monthly references. Friday, March 18th is a bit déjà vu regarding our game plan. Get long the uptrend on a failed short below the 43.90 quarter key reference, or on a pullback from above back down to it as support. Again, we get both opportunities to get long. For later long entries, it is the same game plan at the previous day close. First, we get the failed short mostly from below, and then the pullback to it from above. On and on we go, testing the next references higher, ending the week above the 20-week EMA. Over and over, we see resistance become support and advance higher, and then often an overnight pullback to retest and resume the uptrend from prior support. Here's the summary for the first 3 of the 8-day trading period being reviewed. Looking at this chart, where do you think we're likely to test to the upside next? I expect you are correct if you said the 200-day simple moving average, giving it as the next reference higher, and we just saw price react recently at the 20 and 50 period moving averages. This means that on Friday the 18th, you already have a game plan for the following Monday the 21st. Again, we play our broken record. Uptrend closing near the highs says to look for a pullback to get long, and then perhaps a short or at least profit taking at the 200-day simple moving average. Now let's see how we did. Yes, we got the anticipated pullback, then reversal down from the 200-day simple moving average. I considered this a stop hunt, given the multiple tops put in Friday likely resulted in sell stops accumulating above the highs. I liked the short from the 200-day moving average, given the recent strong reactions at the other moving averages, plus there was a confluence with the 44.6675 wick imbalance reference from the daily chart. Even better, the daily chart had completed the fabled death cross, and this was the first time price was back to tickle the underside of the 200-day moving average. It was no surprise price declined to old resistance, which was a confluence of the 50-day and 50-week simple moving averages, plus the 44.2275 key reference. In my last video, I described how the rapid move of this stop hunt often comes back to retest because it takes time to fill larger orders before making the big move. See here how the basing on the retest respected holding below the 44.6675 key reference, and how the day basically ended neutral back up near the open. To me, this was not an up, down, or sideways day, but instead it was option 4. The institutions had a campaign that day and bought to sell and then bought back up. I think our market assessments lose meaning when we try to force a square peg into a round hole. Monday's overnight price action confirmed the uptrend remained intact, making a higher low and then a higher high. Tuesday, March 22nd's open held the 44.6675 reference, then broke higher. Once again, we play the broken record. In an uptrend, we look to get long on a pullback to a key reference acting as support, which occurred above the 200-day simple moving average and current month high. Price continued up, holding the 44.8450 reference from the daily chart, and then sold off from our next higher key reference, which was the previous month open. This chart is missing the 44.92 major swing low from December last year. When I add that back in, we can see price got above 44.92 but was struggling to hold above it. From here, we look down to look for where price may find support and look up to see where our next reference is anticipated. Up above, we can see the 100-day simple moving average is in focus. Wednesday, March 23rd, price took a rest after its strong 5-day move up that had gotten back up to and above the major December swing low at 44.92. A little profit taking was not unexpected. Here now you can see the 44.92 support turned to resistance, with price falling back to the next lower 44.6675 reference, and then the confluence of the 3 weekly references below that. On Thursday the 24th, we see the overnight price action had broken the structure of the intermediate timeframe downtrend. Again, cue the broken record, looking for the retracement in an uptrend, failed short from below a reference, and then later a pullback from above a reference as our opportunities to get long. And again, up we go. This brings us to Friday the 25th, the last of our 8 days being reviewed. One last time for the broken record. A higher high in the overnight, an opening above key references, has us looking for a pullback to support at a key reference to get long. As expected, price then sold off strongly when it hit the 100-day simple moving average, falling some 45 points, yet holding above the 44.92 major key reference, and ending the week back up near the 100-day simple moving average. Friday resembled another buy to sell to buy back up institutional campaign. Looking at this chart, you should now have some idea of what to expect on Monday, March 28th. I am recording this video on Monday, March the 28th. We had an overnight higher high, then pull back at the open to get long. But price failed to make a higher high and struggled at the confluence of last week's high, Friday's close, and the 100-day simple moving average. Back and forth across the confluence, price ended up making lower highs and lower lows in a range. At about 11:22 Eastern Time, price broke down about 25 points, bouncing first off 44.20.50 key reference, and then again at the previous month open at 45.11.75, where it bottomed for the day. And then price came back up, held our earlier confluence area, and now, currently as I'm speaking, is attempting to reach the overnight high. My trading plan for today was as you would expect. Let the 100-day simple moving average be your guide, and it was. Before we go, I wanted to touch base on those days like Friday the 25th, where the bars on the left side of the chart have scrolled off the monitor. With Tracker PL, I do not project past structural references to the present, but instead project current prices to the past. Here, I can easily see the price line and session low. However, these aren't really helpful on the far right edge of the chart. Now here's the session high and the price line turned on, but again, not very helpful on the right edge of the chart. What I do is to have a second chart scroll to the relevant structure on the left side of the chart. Now I can easily see the 100-day simple moving average coincided with a fresh area of price imbalance, giving me a great odds enhancer for the short. I hope that tip helps you in your trading. Well, that's about all I have for you for this video. I hope you found it helpful and were able to see how daily, weekly, and monthly key references are important, typically several times each and every trading session, as well as how simple but effective the approach of getting long a pullback in an uptrend has been repeatedly over this 8-day trading period. Thanks for watching, and I look forward to seeing you in the next video.